Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Wednesday expert, Ms. Anna Kelly. How you doing, Anna?
I'm great. Good to be here with you.
This is going to be a fun conversation because you and I together, not to age us, but we have over 40 years experience together. And that means we both experienced the run up and the ultimate housing crash and obviously the return. So we are experts that have been through it. So we saw the setup. We were getting loans in the crazy environment, and then we saw it all fall apart.
Yes.
And there are lots of people calling for a housing crash right now. So I thought what you and I should do is revisit. Let's hope we don't have PTSD. Revisit the run up, what happened, how it got worse, how it started compounding, and then talk about why we simply don't have the setup today. So if I were to bring us back to 2006, 7, 8, 9, what do you remember about that period?
Everything was going great. Nobody thought the economy could ever get bad. Everything was booming. Businesses were starting. People were flipping properties like crazy. We flipped a property. We bought speculative real estate, and everything seemed to be really good, right? I worked for AIG at the time, so I was in a department that knew lots about money. Couple years before, I was writing loans for high net worth investors at Bank of America, and I thought everything was really good. And suddenly, in 2008, financial companies started to fail. Yeah. And we're like, oh, what did they do wrong, right? And we started thinking, okay, well, these guys must have done something wrong. And then they start talking about mortgage-backed securities and shorting them and credit default swaps. And I worked for AIG in a division that sold credit default swaps, and I had no idea what they were, right? Yeah. So when everything collapsed seemingly overnight in late 2008 and then through early 2009, I lost 2/3 to 3/4 of my 401k because I was heavy in AIG stock and lots of financial stocks. I had done very poorly on a flip that just didn't sell. So things were starting to slow down in real estate. But overnight, most Americans were really shocked at what happened and how real estate values, not only did the economy collapse and put us into the Great Recession, but real estate values across the country went down significantly. Now, I think the average was only 9 or 10%, but there were areas that had 20, 30% declines because of the things that ran up until then.
Yeah, there's a couple of things that, and again, this is important. Us revisiting this together, folks, should help you understand if and when we have another setup like it. And we'll get into talking about whether or not we have it today. But I was in a market that peak to trough went down 75%. So that was a market I was in. But let's go back and revisit kind of 03, 04, 05, right? Still a good time. Fresno, you can go back and look at it, was the #1 metro, or MSA as they call it, 2 years in a row, 27 and 31% back-to-back years. I thought I was a genius. And what I remember about the setup in the beginning was my first loan, which was Norris Drive. I write about it in my book. That was a real loan. Right? They looked at my financial statement, credit, all of that. But I remembered, like 3 years later, I did a cash out refi with Countrywide. That was not a real loan, because I remember talking to a broker, not a bank, and he's like, just sign it. And my wife's name's Olivia, just have her sign it. I'm like, we're not even filling anything out. Oh, don't worry, we have your file. I'm like, I don't think I've done a loan with you before, but okay. Right. It's like, I don't think that's true, but yeah. And the loan got done. We got the deal. The cash showed up. I was like, oh, okay. I guess he had my file, not knowing I assumed that maybe they did share, like brokers share, but that's not what was happening. He filled it out himself, I'm sure. And we got 2 or 3 more properties. Then in 06, I'm trying to buy the 9th house or 9th property, and nothing works. Right? That same house on Norris Drive that we buy for 107 is now like almost 300, but it's rents for the same amount. I'm like, how the hell do you cash flow these things?
Right.
And it turns out that banks were selling these 2 and 28s. You get 2 years at 0.9% interest, or 1.9 based on your credit. And then at the 2-year mark, they reset at 7.9 or 9.9 based on your credit. And of course, back in these days, they were doing the loan only, they were only underwriting the loan on the first 2 years, because of
Yes.
course you're going to refi it 2 years.
Right.
Of course you are. Why would you not? And I remember going to Olivia, that even back then, I'm like, no, 30-year debt. I'm not, that's, what are you crazy? So we ultimately 1031 all of our houses. So 7 or 8 deals. And every person that bought one of our properties did a 2 and 28, and they lost it. Right. So you can go back on Zillow and look, 1818 North Stripe East 93703. We buy for 107 in like December of 02. We sell it like January of 06 for 265. It does go up all the way to 300. So we sold early, but that person lost it 3 years later for 75 grand.
Wow.
So let's talk about why
Wow.
that happened. People, this is why that happened. It's because in my market of Fresno, California, the deals that were being done were dominated by these adjustable rate mortgages.
Yes.
And I've gone back and looked at it. The percentage of loans in Fresno County, because I can't look at the city, I can only look at the county or the MSA, that were adjustable rate mortgage peaked at 81%.
Wow.
81% of the loans originated in 06 were adjustable rate mortgages. Most of them probably were these 2 and 28s. So, okay, 06, 07, 08, everybody's good. Everybody's fine. They're paying 0.9% interest. Everybody's good. Then they start to reset.
Yes.
And they can't make their payments, right? Their payments go from 800 to 1800,
Yes.
2100. Suddenly they can't pay. So 90 days go by, right? Because no bank in the beginning, folks, you may not realize this today. Banks are nice today. Here, go to this little forbearance form, click this thing. You're in forbearance. Back then in 08, they're like, we're not talking to you until you're at least 90 days late.
Yes.
So everybody got 90 days late. Then they tried to work out with you in 6 months, 9 months, nothing. Because again, banks didn't work with you back then. These people that are used to forbearance today don't get it.
No.
Then after 9 or 12 months, they started the real foreclosure process, which again took time. The average foreclosure in Fresno, California was 18 months. So they bought in 06, no problem till 08. Then they start selling in 09. Guess what? My guy lost his house in 09.
Yes.
Folks, it took years. The people that are calling for a 20% crash today are crazy, inexperienced. They're trying to get a penny off of you. Every time you watch one of the videos, they make a penny on your fear. They don't understand time.
Right.
Here's the deal.
And the underlying issues.
Yeah.
To your point. So you've given all these underlying issues, but another thing that happened, and we've seen a little bit of this with I'm calling it an artificial increase in demand, right? Not that it's really, I mean, it's real, but it's abnormal compared to the long-term norm, right? But when money is easy and cheap, it incentivizes much more demand for housing, right?
Sure.
And so basically interest rates were given out back in the, and it actually started in, I believe in 97 or 98. I was at Bank of America and the Community Redevelopment Act came out under President Bush. And it was basically, let's give everybody first-time home buyers free money to buy a house. We want to incentivize people that normally can't afford it. So you're going to offer these government-backed, but essentially subprime mortgages, although they were conventional government-backed, right?
Yep, I remember.
So they give everybody money, and banks start writing mortgages. Because I remember this. I was in training for my financial advisory program at Bank of America, and I made the rounds of all the departments. So I went in the loan department, and there was checklists from the Fed that were saying, here's what you need, and essentially, if it's a break even, and I don't remember the debt coverage ratio because I really didn't remember that term at the time, but basically if it's a break even and they can pay it and they have a little bit extra for groceries and they attend this class on budgeting, give them the loan, right?
I remember the class. It was funny. One class, financial literacy with one class, Oh my God.
Absolutely. And so we were flooded with new demand for houses with people that really couldn't afford them.
Mhm.
Then that pushed to the subprime market. So there was so much demand. Now subprime countywide, I almost went to work for them actually. And thank God, the day I was going to give my notice at AIG, just funny little story, I got a job offer at Countrywide Mortgage to do subprime mortgages to manage their division. And that night they had a hiring freeze. So things were starting to trickle and happen. And I think that was about 2007, early 2008, when all this was happening. But essentially we have these subprime mortgages, to your point, that give cheap money. So you've got all this artificial demand, right? Mm-hmm. Coming for houses. And now people are qualifying for more. Banks are pushing them to qualify more. And there wasn't a lot of regulation in appraisals. And so demand pushes up prices. The appraisers just kept raising them and raising them and raising them. And then what happened, and this is super important for investors to understand that people don't talk about today, is that these mortgages were sold on the secondary market as A-class paper. These are great quality mortgages with well-approved buyers, right? The reality is, one, because the government incentivized giving loans to non-quality buyers, but number two, because of the greed in the subprime mortgage market and appraisers, values just kept going up. They would fudge. They gave no doc loans, like no documentation, just sign here. We run your credit. You're great. No doc loans. But they packaged them as high quality, low risk loans. When those started being sold on the secondary market and bought by big companies like Bear Stearns and Lehman Brothers and all these big financial institutions, Washington Mutual, they started essentially seeing that some of these things are starting to default. These mortgages may not be as high quality as we think they are. And then banks were buying more of them. Others were shorting them because they realized, hey, we think there's a problem in mortgages. We're going to short them. And then my company, AIG, issued insurance on the values of these financial companies, which the government created, to prop up the financial system. And when mortgages started to be realized that they were not quality mortgages, people were defaulting, rates were going up, and suddenly they're all being sold. Then the housing market crashed, people couldn't pay. So you have a flood of supply, flood of people who couldn't pay. When there's a flood of supply and all of a sudden banks stop lending to new buyers, prices have to plummet. And that's exactly what they did. We are nowhere near that situation today, although we've had maybe argumentatively some artificial increase in demand because of low rates. The fundamentals of the underlying banking and mortgage system have gotten much, much stronger for quality buyers, and they're buying with rates at the bottom for 30 years. So even if rates go up, they're not going to be panicking like owners were before when their rates were down, went way up, but property values fell.
Yeah, there's so much that's not happening today, right? First, for me, the biggest lesson, it's kind of why I'm nervous about commercial, is because the debt structures, right? And again, 81% of the mortgages in my market originated were adjustable rate. That's not good, right? Yeah. And just in case you want to know what's happening now, it's about 2 or 3%. So there's basically what an adjustable rate mortgage in 06 origination meant. You were going to become either a refi or a forced seller because the property was unaffordable after the rate adjusted.
Right.
And again,
or you were a property flipper. I bet. Yeah. I wonder how many of those 81% were flipping properties at the time.
Probably a lot. But yeah, the whole idea is we don't have that structure today. And oh, by the way, you got to live somewhere. What are you going to do? You got a 2.7% mortgage and you're going to rent somewhere. I mean, there's just no setup for a crash today. It is supply and demand. Supply and demand is undefeated. Yes. I think move up buyers. I think the fact is we could see a lot less transactions, and that's what I'm calling for, especially in residential.
Right.
But less transactions does not mean prices fall. In fact, less transactions might mean prices rise.
Right. And I think they will. I think that in well-placed areas, like we've talked about before, really strong demand has all the qualities of people wanting to live there. And lack of supply is going to keep it being a seller's market for a while.
Yeah.
Even if rates tick up 1%, it's still cheaper than it was in 2018. It's still cheaper than it was in 2007 and 2008, right? And so I think supply and demand always works unless there's these underlying things that really skew both supply and demand. So I think in certain markets that maybe went up really, really quickly, you could see, some fall in prices. But to your point, you said something to me that was interesting. I think you said the worst average across the country from 07 to 08 wasn't even 9% fall,
No,
right?
Yeah. Again, I've gone back 50 years, all the way to 1970. The worst year, these are national numbers. The worst year was negative 8.9%, and that was 2009. The
Right.
worst year,
Right.
real estate doesn't fall that fast. And that was
Right.
a year with loans that reset and foreclosures were going on. The worst was
Right.
8.9.
And again, certain pockets of the country did much, much worse,
Of
right?
course.
But other areas did much, much better. In my area in central Pennsylvania, values did not come down at all. And rents actually went up even during the Great Recession. And so again, supply and demand is super important. But we're in a different place. And the other thing that I think is worth mentioning, because people say there's going to be mass short sales and foreclosures, right? Okay. People before got foreclosed on because of the mortgages, right? And they were at such high rates. Now, most people that have bought homes, most people don't stay in their home more than 5 to 7 years, right? So most people that have bought homes and, since 2008 have bought at historically low interest rates that are fixed. And so they're not likely to go under and go in foreclosure, and values are higher and probably will stay for a little bit. The other thing is, because of the pandemic and the eviction moratorium and the mortgage moratorium, the federal government has told banks, you have to work out the buyers. You tack payments on the end, whatever you need to do, but we do not want a mass wave of foreclosures. So lenders, even though they might not like it, are still working with homeowners to keep them in their homes. And that's going to keep out the flood of foreclosures that could then cause a decrease in value. So I'm not worried generally about prices coming down significantly.
No.
I bought a property oceanfront in Florida. I have 2 of them that I've just bought in the last couple of months. And I'm excited about them. Did I pay top dollar? Absolutely. But so many people are moving to Florida and want to be on the water. I know in a recession, my values could come down a little bit. But do I care? No, because I have 30-year fixed financing, sub 4, oceanfront properties that'll always have some attraction. And even if they came down 10%, I know that in recessions, people rent them more and I'll make more income, right? So you only have to worry about real estate values coming down, let's say max 8%, right? Even if they do, it's not forever. It's usually for a year or 2. You come out of the recession, you go into recovery, and we go right back to where we were. So look at supply and demand, look at the markets that you're investing in, invest in areas that people want to live and they'll continue to pay to live there. And your properties will go up over time. And you don't have to be panicked about, suddenly the value of your property is going down. And again, to your point, that's residential. Commercial, there's a lot of nuance. We can have an entire episode just on commercial. But the same fundamentals work, right? If you have good debt, good fixed debt for as long as you can get on a commercial deal in a well-placed area, you've got some cash to come up with in case you have to, values come down a little bit, you have to put a little bit more down on the mortgage, you can still do really, really well. But commercial, there's definitely a little more risk because of the fact that interest rates are not set for 20, 30 years like they are in real estate.
Very, very great. I love this conversation. Folks, no housing crash this year. Even if rates went to 10%, it would take so much time for the system to work its way out. It'd be next year, best case. Transactions would fall immediately. Let's be clear.
Yes.
But prices wouldn't. So Anna, how can people find you?
Great. You can find me here every Wednesday. You can find me on social media, Anna Kelly, REI Mom. And if you're an accredited investor looking to invest in apartment communities where we make a difference and impact on our residents, you can follow me at greaterpurposecapital.com.
Very cool. Thanks, Anna.
Thank you.